Question 1. An Illinois auto insurance policyholder has elected minimum liability limits of 25/50/20. If this policyholder causes an accident resulting in bodily injury to one person for $30,000, bodily injury to a second person for $25,000, and property damage to another vehicle for $18,000, how much will the policy pay for this single occurrence? A. $25,000 for the first person, $25,000 for the second person, and $18,000 for property damage. B. $25,000 for the first person, $20,000 for the second person, and $18,000 for property damage. C. $25,000 for the first person, $25,000 for the second person, and $20,000 for property damage. D. $30,000 for the first person, $25,000 for the second person, and $18,000 for property damage. Answer: B. $25,000 for the first person, $20,000 for the second person, and $18,000 for property damage. The liability limits of 25/50/20 represent $25,000 per person for bodily injury, $50,000 per accident for bodily injury, and $20,000 for property damage. For the bodily injuries, the policy pays up to $25,000 for the first person and up to $25,000 for the second person, as the total per accident limit of $50,000 has not been exceeded. However, since the second person's claim is for $25,000, and the first person already used $25,000 of the per person limit, the remaining $25,000 of the per accident limit is paid to the second person, meeting their claim. The $18,000 property damage claim is paid in full as it is within the $20,000 per accident property damage limit. Remember that liability limits are often structured as a split limit, meaning there are distinct maximums for injuries to one person, total injuries per accident, and property damage per accident. Question 2. Which of the following statements regarding the Illinois Workers' Compensation Exclusive Remedy Rule is most accurate? A. Injured employees can always choose to sue their employer in civil court instead of accepting workers' compensation benefits. B. The exclusive remedy rule generally prevents an injured employee from suing their employer for negligence if the injury is covered by workers' compensation. C. The rule only applies if the employer is proven to be entirely without fault for the workplace injury. D. An exception to the exclusive remedy rule applies if the employer's actions constituted gross negligence or willful misconduct. Answer: B. The exclusive remedy rule generally prevents an injured employee from suing their employer for negligence if the injury is covered by workers' compensation. The exclusive remedy rule is a cornerstone of workers' compensation law, stating that if an injury is covered by workers' compensation, the benefits provided by the system are the sole remedy available to the injured employee against their employer. This means the employee generally cannot sue their employer in civil court for negligence, regardless of fault. The purpose of this rule is to provide a swift, no-fault benefit system while limiting the employer's exposure to potentially massive civil lawsuits. Remember that workers' compensation is designed to be the primary and often only recourse for job-related injuries, offering a trade-off between guaranteed benefits and the inability to sue. Question 3. Under a Commercial General Liability (CGL) policy, which of the following scenarios would likely be covered under coverage B, personal and advertising injury? A. A customer slips and falls on a wet floor inside the insured's retail store, sustaining a broken leg. B. The insured's advertising campaign falsely claims a competitor's product is defective, leading to a lawsuit for libel. C. An employee of the insured accidentally damages a client's property while performing work at the client's office. D. The insured's product causes bodily injury to a consumer due to a manufacturing defect. Answer: B. The insured's advertising campaign falsely claims a competitor's product is defective, leading to a lawsuit for libel. Coverage B of a CGL policy specifically addresses personal and advertising injury, which includes offenses such as libel, slander, false arrest, malicious prosecution, and copyright infringement arising from the insured's business activities. In this scenario, the false claim about a competitor's product leading to a libel lawsuit directly falls under the definition of advertising injury. Bodily injury and property damage, as described in the other options, are typically covered under Coverage A. Always distinguish between physical injuries and property damage, Coverage A, versus reputation and intellectual property-related offenses, Coverage B. Question 4. An insured driver in Illinois allows a friend to borrow their car. The friend, while driving, causes an accident that injures a pedestrian. The friend has no personal auto insurance. How will the insured's personal auto policy, PAP, typically respond? A. The insured's PAP will not cover the friend because the friend is not a named insured on the policy. B. The insured's PAP will provide primary coverage for the friend as a permissive user, up to the policy limits. C. The friend's lack of insurance means the pedestrian's uninsured motorist coverage will be the primary source of recovery. D. The insured's PAP will provide only excess coverage if the friend's non-existent insurance policy somehow applies. Answer: B. The insured's PAP will provide primary coverage for the friend as a permissive user, up to the policy limits. A personal auto policy typically extends coverage to anyone operating the insured vehicle with the named insured's permission, often referred to as a permissive user. In this situation, the friend, as a permissive user, is covered under the insured's PAP for liability to the injured pedestrian. The primary responsibility for coverage usually follows the vehicle itself. Remember that when someone borrows your car with permission, your policy typically covers their liability while driving it, protecting both you and them. Question 5. In Illinois, which of the following actions by an insurance producer would be considered an unfair claims practice? A. An insurer requiring a proof of loss form to be submitted within 60 days of the loss. B. An insurer refusing to pay a claim solely because the insured filed a complaint against them. C. An insurer using an independent adjuster to investigate a complex claim. D. An insurer informing an insured about coverage limitations before processing a claim. Answer: B. An insurer refusing to pay a claim solely because the insured filed a complaint against them. Unfair claims practices in Illinois, regulated by the Department of Insurance, prohibit insurers from engaging in actions that are unjust or unreasonable in the handling of claims. Refusing to pay a valid claim simply because the insured filed a complaint is a clear example of acting in bad faith and constitutes an unfair claims practice. Legitimate requirements for claim submission, using adjusters, and explaining policy limitations are all standard and acceptable practices. An insurer must base its claim decisions on policy terms and facts, not on retaliation. Question 6. An employee develops a severe respiratory illness after years of working in an industrial plant, and the illness is directly linked to prolonged exposure to chemicals at the workplace. Under Illinois workers' compensation, what type of condition is this most likely to be classified as? A. An ordinary disease of life. B. A scheduled injury. C. An occupational disease. D. A permanent partial disability. Answer: C. An occupational disease. An occupational disease is a condition that arises out of and in the course of employment, is peculiar to the occupation, and is caused by hazards inherent in the particular employment. Unlike an accidental injury, an occupational disease typically develops over a period of time due to repetitive exposure or conditions inherent to the job. In this scenario, the respiratory illness directly linked to long-term chemical exposure at work perfectly fits the definition of an occupational disease. Keep in mind that occupational diseases are treated similarly to accidental injuries under workers' compensation laws, ensuring benefits for workers whose health is compromised by their work environment. Question 7. A Commercial General Liability, CGL, policy with an occurrence trigger provides coverage based on A. When the claim is first reported to the insurer, regardless of when the injury or damage occurred. B. When the policy period is active and the injury or damage occurs within that period, even if the claim is reported much later. C. When the injury or damage is discovered by the insured, regardless of when it actually occurred. D. When the first legal action is filed against the insured, irrespective of the actual occurrence date. Answer: B. When the policy period is active and the injury or damage occurs within that period, even if the claim is reported much later. An occurrence CGL policy provides coverage for bodily injury or property damage that happens during the policy period, regardless of when the claim is actually reported. This means if an event, occurrence, that causes injury or damage happens today, but the claim isn't filed for several years, the policy in force on the date of the occurrence will respond. This differs significantly from a claims-made policy, which covers claims reported during the policy period. Remember, with an occurrence policy, coverage attaches when the incident happens, not when it's reported. Question 8. What type of coverage would pay for injuries sustained by a pedestrian who was hit by a driver who fled the scene and cannot be identified, assuming the pedestrian has their own auto insurance policy with this specific coverage? A. Collision coverage. B. Property damage liability coverage. C. Uninsured motorist bodily injury coverage. D. Medical payments coverage. Answer: C. Uninsured motorist bodily injury coverage. Uninsured motorist, bodily injury coverage is designed to protect an insured and their passengers in the event of an accident caused by an uninsured motorist or a hit-and-run driver, who by definition cannot be identified and thus is uninsured. It covers bodily injuries that the insured or their passengers sustain. Collision coverage pays for damage to the insured's vehicle, property damage liability covers damage to others' property, and medical payments coverage pays for medical expenses regardless of fault. Coverage is crucial for protecting against financially irresponsible drivers. Question 9. An Illinois driver is involved in an at-fault accident. To demonstrate financial responsibility as required by Illinois law, which of the following is not a typically accepted method? A. Maintaining an auto liability insurance policy with state minimum limits. B. Posting a bond with the Illinois Secretary of State. C. Obtaining a certificate of self-insurance from the Department of Financial and Professional Regulation. D. Providing proof of assets exceeding $100,000 to the Department of Insurance. Answer: D. Providing proof of assets exceeding $100,000 to the Department of Insurance. Illinois law requires drivers to demonstrate financial responsibility, primarily to ensure that victims of auto accidents can be compensated. Accepted methods include carrying a liability insurance policy with at least the minimum required limits, currently 25/50/20 in Illinois, posting a bond with the Secretary of State, or obtaining a certificate of self-insurance if you have a large number of vehicles and meet specific financial criteria. Simply providing proof of personal assets to the Department of Insurance is not a recognized method for satisfying this ongoing financial responsibility requirement. Always ensure you or your clients meet the state-specific financial responsibility requirements to avoid penalties. Question 10. A small Illinois employer offers only workers' compensation coverage but accidentally omits employers' liability coverage, Part 2, from their policy. If a third-party claim is brought against the employer by a spouse of an injured employee for loss of consortium, how would the policy respond? A. The workers' compensation section, Part 1, would cover the claim because it arises from an employee's injury. B. The claim would likely not be covered, as employer's liability coverage is typically needed for such third-party actions against the employer. C. The employer's Commercial General Liability, CGL, policy would cover this claim under bodily injury. D. The claim would be denied under the exclusive remedy rule, as it relates to a work injury. Answer: B. The claim would likely not be covered, as employer's liability coverage is typically needed for such third-party actions against the employer. Workers' compensation, Part 1, primarily covers the statutory benefits due to the injured employee, while employer's liability, Part 2, often called stopgap in monopolistic states but standard in Illinois, covers the employer for common law liability outside the workers' compensation statute. Claims from third parties, such as a spouse suing for loss of consortium due to an employee's injury, or claims of dual capacity, are typically covered by employer's liability, not the workers' compensation benefits section itself. Without this coverage, the employer would have to pay out of pocket. Remember that employer's liability is a critical component of a workers' compensation policy that protects the employer from certain lawsuits not covered by the standard statutory benefits. Question 11. Under the Medical Payments, Coverage C, section of a Commercial General Liability, CGL, policy, which of the following statements is true? A. Coverage C applies only to injuries sustained by the insured's employees. B. Coverage C pays for necessary medical expenses regardless of fault, for injuries occurring on the insured's premises or due to the insured's operations. C. Coverage C is subject to the same aggregate limits as Coverage A, bodily injury and property damage. D. Coverage C applies only if the injured party files a lawsuit against the insured. Answer: B. Coverage C pays for necessary medical expenses regardless of fault, for injuries occurring on the insured's premises or due to the insured's operations. Medical payments coverage, Coverage C, in a CGL policy provides immediate, no-fault coverage for medical expenses for injuries sustained by non-employees on the insured's premises or because of the insured's business operations. The regardless of fault aspect is key, meaning it's paid without the need to prove negligence. It is distinct from Coverage A, which requires legal liability, and it has its own separate per-person limit, not tied to the aggregate limits of Coverage A. Its purpose is to promptly pay smaller medical bills, potentially preventing larger liability claims. Question 12. Which of the following is the best example of a situation where strict liability might apply in Illinois? A. A driver causes an accident due to distracted driving. B. A company manufactures a product that is inherently dangerous and causes injury when used as intended. C. A landlord fails to fix a known hazard, leading to a tenant's injury. D. A dog bite occurs, but the dog has no history of aggression. Answer: B. A company manufactures a product that is inherently dangerous and causes injury when used as intended. Strict liability holds a party responsible for damages or injuries even if they were not negligent or did not intend to cause harm. This legal concept often applies to ultra-hazardous activities, like blasting, animal bites, though often with specific statutes like Illinois' Animal Control Act, which has elements of strict liability, and, most commonly, product liability cases involving defective or unreasonably dangerous products. The other options involve negligence, distracted driving, landlord's failure, or may not meet strict liability criteria depending on specific state statutes, dog bite without prior aggression. When you see strict liability, think liability without fault, often tied to inherently dangerous activities or products. Question 13. An Illinois auto insurer intends to non-renew a personal auto policy. What is the minimum number of days notice the insurer must typically provide to the insured before the non-renewal takes effect? A. 10 days. B. 20 days. C. 30 days. D. 60 days. Answer: C. 30 days. In Illinois, insurers are generally required to provide at least 30 days advance written notice to an insured before non-renewing a personal auto policy. This provides the insured sufficient time to find alternative coverage before their current policy lapses. This regulation is in place to protect consumers from sudden loss of coverage. Remember, knowing these specific notice periods is crucial for compliance and understanding consumer protection laws. Question 14. An employee in Illinois suffers a work-related injury that results in them being unable to perform any work for a period of time, but they are expected to fully recover and return to their previous job. What type of workers' compensation benefit would they most likely receive during this period? A. Permanent total disability, PTD, benefits. B. Temporary total disability, TTD, benefits. C. Permanent partial disability, PPD, benefits. D. Medical benefits only. Answer, B. Temporary total disability, TTD, benefits. Temporary total disability, TTD, benefits are paid to an injured worker who is temporarily unable to perform any work due to a work-related injury or illness. The key aspects are temporary and total, meaning they are expected to recover and resume employment. Permanent total disability, PTD, is for workers who can never return to gainful employment, and permanent partial disability, PPD, is for workers who have a permanent impairment but can still work. Medical benefits cover treatment costs, but TTD replaces lost wages. TTD benefits provide income replacement during a period of complete, but temporary, incapacitation. Question 15. The pollution exclusion in a standard commercial general liability, CGL, policy typically excludes coverage for A. All costs arising from pollution, regardless of how it occurred. B. Bodily injury or property damage arising out of the discharge, dispersal, seepage, migration, release, or escape of pollutants. C. Only pollution that is intentional and gradual. D. Pollution caused by sudden and accidental events. Answer, B. Bodily injury or property damage arising out of the discharge, dispersal, seepage, migration, release, or escape of pollutants. The standard absolute pollution exclusion in a CGL policy is very broad, aiming to exclude coverage for virtually all bodily injury or property damage claims arising from pollutants. It doesn't differentiate between sudden and accidental versus gradual pollution. It excludes coverage for the discharge, dispersal, seepage, migration, release, or escape of pollutants. This exclusion was introduced to clarify that general liability policies are not intended to cover environmental cleanup costs or related liabilities, which are typically covered by specialized environmental impairment liability policies. Understanding this exclusion is critical because it significantly limits CGL coverage for pollution-related losses. Question 16. In Illinois, which of the following powers is not typically granted to the Director of Insurance? A. Regulating insurance rates. B. Licensing insurance producers and companies. C. Enacting new insurance laws. D. Conducting examinations of insurers' financial records. Answer, C. Enacting new insurance laws. The Director of Insurance in Illinois, as the chief insurance regulator, has broad powers to enforce existing insurance laws, promulgate rules and regulations to implement those laws, license producers and insurers, conduct financial examinations, and approve policy forms and rates. However, the power to enact new laws is reserved for the state legislature. The Director can propose legislative changes, but they cannot create laws themselves. The Director's role is administrative and enforcement, not legislative. Question 17. Which of the following would not be covered under the other than collision, comprehensive, section of a personal auto policy? A. Damage to the car from a hailstorm. B. Theft of the car's engine. C. Damage to the car's windshield from a rock hitting it while driving. D. Damage to the car from hitting a pothole. Answer, D. Damage to the car from hitting a pothole. Other than collision, often called comprehensive, coverage pays for direct and accidental loss to the insured vehicle caused by perils other than collision or upset. These perils typically include fire, theft, vandalism, falling objects, explosion, earthquake, windstorm, hail, flood, riot, and contact with birds or animals. Damage from hitting a pothole is considered a collision with the road or an object in the road, thus falling under collision coverage. The distinction is crucial because the two coverages have separate deductibles. Question 18. An insurance policy contains a subrogation clause. This clause allows the insurer to A. Cancel the policy at any time without prior notice. B. Recover payments from a negligent third party after paying a claim to its insured. C. Adjust the policy premium based on the insured's claims history. D. Refuse to pay a claim if the insured contributed to the loss. Answer: B. Recover payments from a negligent third party after paying a claim to its insured. The subrogation clause is a fundamental principle in insurance that allows the insurer, after paying a claim to its insured, to step into the insured's shoes and pursue recovery from the party legally responsible for the loss. For example, if your insurer pays for your car damage caused by another driver, the subrogation clause enables your insurer to then sue that negligent driver to get their money back. This prevents the insured from being compensated twice for the same loss and helps control insurance costs by shifting the financial burden to the at-fault party. Question 19. In Illinois workers' compensation, if an injured worker also recovers damages from a third party, example a negligent driver who caused the injury during work, how does the Workers' Compensation Act typically address this? A. The worker must choose between workers' compensation benefits and a third-party settlement. They cannot receive both. B. The employer or their workers' compensation insurer has a right of subrogation against the third-party recovery to recoup benefits paid. C. The third-party recovery is entirely separate, and the workers' compensation benefits continue unaffected. D. The employer's liability policy would pay the third-party claim, not the workers' compensation insurer. Answer: B. The employer or their workers' compensation insurer has a right of subrogation against the third-party recovery to recoup benefits paid. Illinois workers' compensation law, like most states, incorporates a subrogation provision for third-party recoveries. If an employee is injured at work due to the negligence of someone other than their employer, a third party, and the employee receives workers' compensation benefits and also recovers damages from that third party, the employer or their workers' compensation insurer has a lien or right to recover the workers' compensation benefits they've paid from the third-party settlement. This prevents the injured worker from experiencing a double recovery for the same injury and helps to offset the costs to the workers' compensation system. Question 20. A restaurant holds a private corporate event and serves alcoholic beverages to its guests, some of whom become intoxicated. One guest leaves the event and causes an accident. Under a standard Commercial General Liability (CGL) policy, how would the liquor liability exclusion generally apply to the restaurant? A. The CGL policy would cover the restaurant's liability for the intoxicated guest's actions because they are not in the business of selling alcohol. B. The CGL policy would exclude coverage for the restaurant's liability related to the intoxicated guest, even though they were not selling alcohol for a charge. C. The CGL policy would provide coverage only if the restaurant is legally required to carry liquor liability insurance. D. The CGL policy would cover the restaurant, but only if they have a separate post-liquor liability endorsement. Answer: A. The CGL policy would cover the restaurant's liability for the intoxicated guest's actions because they are not in the business of selling alcohol. A standard CGL policy typically contains a liquor liability exclusion for those in the business of manufacturing, distributing, selling, serving or furnishing alcoholic beverages. However, it usually includes an exception for businesses that are not in the business of selling or serving alcohol but might provide it incidentally, such as a restaurant serving alcohol at a private event without an additional charge. This is often referred to as post-liquor liability. If the restaurant is not in the business of selling or serving alcohol for a fee, their liability arising from serving alcohol at a private event would generally be covered under the CGL policy's coverage A. If they were in the business, a separate liquor liability policy would be needed. Question 21. An insured in Illinois owns several vehicles but also frequently drives company-owned vehicles that are not insured under his personal auto policy, PAP. To ensure he has personal liability coverage when driving these non-owned autos, what endorsement would be most appropriate to add to his PAP? A. Extended non-owned coverage for named individual. B. Rental car reimbursement coverage. C. Miscellaneous type vehicle endorsement. D. Named non-owner coverage. Answer: A. Extended non-owned coverage for named individual. The extended non-owned coverage for named individual endorsement is specifically designed for situations where an insured or a family member regularly drives a non-owned vehicle that is not available for the regular use of the insured, such as a company car provided by an employer. This endorsement extends the liability, medical payments, and uninsured/underinsured motorist coverages of the individual's PAP to cover them while driving such vehicles. Named non-owner coverage is similar but is typically for individuals who do not own a car but drive borrowed cars. The key here is regularly drives company-owned vehicles. Question 22. Which of the following best describes the fundamental difference between a malpractice policy and an errors and omissions (E&O) policy? A. Malpractice covers bodily injury claims, while E&O covers property damage claims. B. Malpractice covers professionals in the medical field, while E&O covers non-medical professionals for financial losses due to negligent acts or omissions. C. Malpractice is an occurrence-based policy, while E&O is always claims made. D. Malpractice covers intentional torts, while E&O covers unintentional torts. Answer: B. Malpractice covers professionals in the medical field, while E&O covers non-medical professionals for financial losses due to negligent acts or omissions. Both malpractice and errors and omissions (E&O) policies are types of professional liability insurance, designed to protect professionals from liability arising from negligent acts, errors, or omissions in the performance of their professional duties. The key distinction lies in the profession covered. Malpractice insurance specifically covers medical professionals, example doctors, nurses, dentists, for bodily injury and personal injury claims, while E&O insurance covers non-medical professionals, example real estate agents, insurance producers, architects, accountants, for financial losses suffered by clients due to their professional negligence. Both are typically claims-made policies. Question 23. In Illinois, which of the following activities by an insurance producer is considered rebating? A. Sharing commissions with another licensed producer on the same policy. B. Providing an applicant with a free gift worth $20 as an inducement to purchase a policy. C. Offering an insured a discount on their premium after a period of no claims. D. Waiving the policy fee for a loyal client as a gesture of appreciation. Answer: B. Providing an applicant with a free gift worth $20 as an inducement to purchase a policy. Rebating is an illegal practice in Illinois, defined as offering an applicant for insurance any special inducement or favor, not specified in the policy, as an incentive to buy insurance. This includes giving away anything of value, beyond a certain de minimis amount, often a nominal value like $25, but state laws vary, so free gift is the key indicator that is not part of the policy contract. Sharing commissions with another licensed producer is permitted, and claim-free discounts are legitimate policy features. Waiving a policy fee would generally be considered an illegal rebate if it's not part of a standard, approved offering. The core idea of rebating is providing an unfair advantage or inducement outside the policy terms. Question 24. A claims-made commercial general liability, CGL, policy requires which of the following for coverage to apply? A. The injury or damage must occur during the policy period. B. The claim must be first made against the insured during the policy period or extended reporting period. C. Both the injury/damage and the claim must occur during the policy period. D. The injury or damage must occur after the retroactive date but the claim must be reported within 72 hours. Answer: B. The claim must be first made against the insured during the policy period or extended reporting period. A claims-made CGL policy provides coverage for claims that are first made against the insured during the policy period, or during an extended reporting period, as long as the injury or damage occurred on or after the retroactive date specified in the policy. The key difference from an occurrence policy is that the claim reporting date, not the occurrence date, is what triggers coverage. This structure is designed to limit the insurer's long-term exposure to unknown future claims arising from past incidents. Understanding the claims-made trigger, especially the importance of the retroactive date and extended reporting periods, is critical. Question 25. Under the Standard Personal Auto Policy, PAP, which of the following is not typically considered a covered auto? A. Any vehicle shown in the declarations. B. A trailer owned by the named insured. C. Any vehicle the named insured acquires during the policy period, if reported to the insurer within 14 days. D. A vehicle owned by a relative of the named insured who lives in another state. Answer: D. A vehicle owned by a relative of the named insured who lives in another state. A personal auto policy defines covered auto to include vehicles listed on the declarations page, newly acquired vehicles, subject to reporting requirements, typically 14 or 30 days depending on coverage, and trailers designed for use with a private passenger auto. Vehicles owned by relatives who do not reside in the same household or are not family members, as defined by the policy, are generally not considered covered autos under the named insured's policy. Coverage follows the vehicle, not the person, unless a specific endorsement applies. Remember that the PAP is primarily for vehicles owned by the named insured and resident family members.